At Insightful Value, we shine a light on solid companies hiding in plain sight, and today's spotlight is on Secom, a Japanese security giant whose stock has quietly dipped to multi-year lows. If you're into low volatility, dividend-paying global plays, this one might just deserve a spot on your radar. This review is for informational and educational purposes only. It is not financial advice. If you enjoy real, research-driven breakdowns like this, hit the like button, subscribe to the channel, and let's jump into it. 2. Secom is a leader in security services across Japan and parts of Asia. The company provides everything from home and commercial security systems to emergency response, monitoring, fire protection, and even elder care services. Secom operates a tech-driven business that combines traditional on-site services with modern surveillance and cloud-based monitoring. It's Japan's first and largest security company, and its brand is trusted across residential and corporate markets alike. So why is the stock down? Despite a defensive business model and consistent cash flow, Secom's share price has declined around 15% from its highs over the past year. One reason is investor caution around Japan's broader economic trajectory and interest rate environment. Another is modest revenue growth. In its latest fiscal year report, Secom posted a revenue increase of just under 4%, with operating profit roughly flat. Net income did rise nearly 9% year over year, but markets clearly wanted more. Still, the fundamentals remain solid. Secom's operating margin is above 11%, and its return on equity hovers around 8%. Reasonable for a company with virtually no debt and a heavy focus on long-term stability over aggressive growth. The balance sheet is strong, with more cash than debt, and the company has been making targeted acquisitions to expand its tech and elder care businesses in Asia. Secom also owns real estate and other assets that provide an additional layer of stability not always visible in the income statement. Dividends are a highlight. Secom has consistently paid and raised dividends for over a decade, with the current payout yielding around 2.2%. That's modest by international standards, but high for Japanese stocks. The payout ratio is conservative, and the dividend has grown steadily alongside earnings and free cash flow. From a value perspective, the stock trades at a price-to-earnings ratio in the low teens, which is lower than its historical average, and also a discount to peers like Securitas or Allied Universal. The stock may be suffering more from market sentiment than business fundamentals. However, there are still risks. Japan's aging population is both a challenge and an opportunity. While Secom is pivoting into elder care services, the pace of adoption and profitability of this segment remains uncertain. Additionally, the company's international expansion has been cautious and slow-moving, which may limit growth. Tech disruption is another wild card. Secom must continuously invest to stay competitive with newer, leaner players entering the security space. So, is Secom a long-term bargain or a value trap? That depends on how you view consistency, stability, and dividends versus faster-growing alternatives. The company is unlikely to double revenue anytime soon, but it may appeal to investors looking for reliable income and defensive exposure to the Japanese market. At Insightful Value, we deliver no-hype, in-depth research on companies the market might be mispricing. We break down the core data and explain why it matters without the jargon. Whether you're just getting started or a seasoned investor, we're here to help you spot overlooked value plays. For more on Secom and other undervalued companies, check out insightfulvalue.com. And remember to subscribe to our channel and like the video if you found this helpful. More insights are coming your way.